Rohr here with another concise highlight on Tuesday, June 17th, 2014. It's currently approximately 7 a.m. U.S. Central Time, and we are providing another concise highlight because very little has changed. We're starting to get a sense, even with some short-term trading volatility, there's not much trend movement out there. It feels like a classic case of federalysis, that the markets get a little bit of paralysis in front of the FOMC, which is, of course, early tomorrow afternoon U.S. time. And the indication of that is very interesting as well, because there's conditions that are anticipating things all over the map. Some Fed governors, along with Bank of England's Governor Mark Carney, speaking of how rate hikes may have to come sooner than people expect. However, we consider that a lot of talk that isn't backed up much by the economic growth. And what's interesting about all that is that the U.S. data was positive on Monday after being a bit more negative late part of last week, but Chinese foreign direct investment tanked. It's at a 16-month low on, as reported on Tuesday morning. German ZEW sentiment, the forward view, was negative. And most interestingly, UK inflation numbers, which are all released at once, were below estimate. So puts paid in some ways to Mr. Carney's indication rates might have to go up sooner than expected. Now we're still looking into U.S. CPI and housing starts and building permits today, but it's just very interesting that along with this weaker data, yesterday the IMF came out and Christine Lagarde virtually lectured the U.S. on the degree to which it might have to leave rates lower than most people expect, not just because of the weakness this year. They downgraded their forecast from 2.8% to 2% for 2014, but because of long-term demographic trends. So getting over to what this means in the short term for the U.S. S&P 500, we have now moved over to the September contract, pending Thursday's expiration of the June contract. And this is at about a $7. We classically mention $6. This is at a $7 discount to the June levels. And that's going to impact the implications for the continuation chart a bit. We'll get to that in a moment. But for right now, the market's had a pretty nice sell-off. And as we noted, once the lead contract got below its channel support and the 1937.38 level, so kind of consistent with where the September contract broke down from the channel at about 1933, it wasn't surprising that all in one day, last Thursday, the market made it down to the next support, which was 1925 in the June and the discounted 1920 here in the SEP. And it also wasn't surprising, it popped right back up to test resistance. You can't see it in this thin trading here going back to the earlier part of the month, but on the way up, the market had quite a bit of congestion starting down here in about the 20 area or 25 or so on the June chart. And looking at what we would see next, well, the resistance on that lead contract chart is up at around 1942 to 45, and even though we have this federalysis bit of stagnancy in front of the Fed, that tends to take a constructive tone, especially now with what the IMF said, a little weaker data. Let's presume whatever other Fed governors are saying, Janet Yellen is going to stick to her low rates for a long time accommodative line. And of course, if we might go up to 42 to 45 in the lead contract, that's going to be the equivalent of approximately 35 to 38 back up to test this higher congestion area in the September. So somewhat more of a bid, but we don't think this is going back to a real bull. If anything, the tendency is once the Fed is out of the way for the market to revert back to allowing the undertone and the data are kind of weak. And if we take a look at the intermediate term charts, we can see how the September contract, just as the June left the gap slightly above 1900, left a gap slightly below 1900. This is from 1897 on down to 1892 roughly. A lot of Fibonacci support in there. So as we were saying yesterday, this is a correction in a bull so far. Even if the lead contract, which will be September as of this Thursday, if it gets down to around 1900 or even somewhat below it, there's the lead contract gap, there is the September contract gap, and there's just a lot of congestion in each case into the upper 1800s. As a matter of fact, if you'll recall, we focused for quite some time on the lead contract about the importance of 1883 to 87 across time, and only once the market escaped that in late May into the Memorial Day weekend was it ready to gap higher, coming back in. And if the market should push up first, it's going to have to push up through all these gaps and other resistance up around the 1950 area, because that's where the weekly oscillator resistance is at this point as well. And what's important about this is that that really sets quite a hurdle for the September S&P at its discounted level to be able to get bullish again before there's probably a bit more of a correction.